Okay, so you guys can see my screen now. Um, all right. Bet you did. I have to choose between my mouse and pen. Design. Okay, so the first thing that we're going to do is charging is equation. So what you need to know about the accounting equation, I mean, what the book tells you is that your assets are equal to your owner's equity plus your liabilities, right? Or your owner's equity is equal, your owner's equity is equal to, sorry, this mic is looking up. Okay. Your owner's equity is equal to your assets minus your liabilities, or your liabilities are equal to your assets minus your owner's equity. So you can write the accounting equation in whatever manner that you choose to write it in. I'm just going to do a lot of page breaks. Okay. So that's the accounting equation, but it doesn't go into detail on the accounting equation. Another thing that I'd like to make you aware of, if you look at the accounting equation, so if I go back down to the accounting equation, you'll see this is a statement of profit and loss and other comprehensive income, right? Because in the statement of profit and loss and other comprehensive income, you will have your non-current assets and your current assets, right? You will also have, okay, then obviously you'll add these up and you'll get your total assets. Then you'll have your equity and liabilities, which will consist of owner's equity number 1, number 2, your non-current, let me just draw like a line here, your non-current liabilities, your current liabilities, and then at the end you'll get, after adding these ones, you'll get your total equity and liability. Okay, so obviously you'll come here, you'll say these are your total assets. Your total assets and your total equity and liabilities will always be equal according to the accounting equation. And then if you have to find a balancing figure, usually owner's equity, which is the new capital amount, you will then say your total equity minus your current liabilities and minus your non-current liabilities, right? Okay, so that's just the face of it. I didn't go into detail of listing the current assets and listing the non-current assets or non-current liabilities or current liabilities. Okay, so I'm gonna go back up. So the accounting equation that I want you to know, and I've seen some of your notes that your lecturer has provided for you. It has a page 50 in the accounting 1A textbook, which has this. just not the pluses and the minuses. So you have your list of accounts there. Okay, I don't have my blackboard open. I'll show you. But anyway, so under you have your assets, you have your liabilities, you have your owner's equity. Under your owner's equity, you have capital contribution, you have incomes, you have drawings, and you have expenses. Okay. These decrease on this side and increase on the credit side. These increase on the debit side and increase on the credit side, debit side, and decrease on the credit side. Okay, so you will notice that your assets increase on the debit side. So this is the debit side, this is the credit side. This just means, the debit just means, I'll write it down here, left hand side of a T account. What is a T account, you may be asking? Every account in accounting. So under your assets, you'll have bank, debtors control, you'll have input VAT, and so forth, right? All of those are accounts. To show the movement in the accounts, you will draw a T on that account. You will show all the transactions that increase this account and all the transactions that decrease this account. At the end, you will have a balance on how much this account is worth at the end of the month, at the end of the year, end of 6 months, whatever the case may be. So that's a T account. So the T account is just a representation of the account. So it's just you drawing, saying, okay, this is the account and this is the movement. So the T account is there to show the movement that happened during the year in that account. Okay, I'm just gonna undo that because I need the space. Okay, then the credit is going to be the right hand side of a T account. Okay. Now, debit does not mean positive and credit does not mean negative. Okay. It depends on the nature of the account. So if it's an asset, it's going to increase on the debit side. So you could say its positive side is the debit side. If it's a liability, it's going to increase on the credit side. So you can say the positive side of a liability is going to be on the credit side, right? Now, when your assets increase, these are things that you own, right? A car, a table, a computer, money in the bank. When these things increase, this is good for your business because the things that you own are increasing, right? Your liabilities are things that you owe. So there are things or people that you owe. So you either owe money and who you owe it to. So you owe the bank money because you got a bank loan. You owe builders money because you leveraged their stock so you could sell it. So leveraging meaning that you took their stock and said, okay, we're not going to pay you now. Can we take your stock and then we sell it and then we'll pay you back in 30 days. So you have credit terms with them. Okay, then you decide on the 30 days also your credit terms. So that's when you leverage the stock. So you owe builders the money or the value of the stock, so the cost price of the stock, their selling price, but your cost price. Okay. And then you pay them back and all that stuff. Cool. Then this is the worth of the business, your owner's equity. So when you take things that you own and you subtract the things that you owe, you are left with the things that you have. So if you have 5 rand and you owe 2 rand, you actually have 3 rand, right? You are worth 3 rand, or the money that you own is 3 rand, because of that 5 rand, 2 rand belongs to somebody else that you need to pay. So that's what you're going to be looking at with the accounting equation. So this has to always balance, okay? I don't know why it's still not letting people just enter. I set up the setting. Let me just check the setting quickly. As far as I remember, I set up the setting to allow people to enter without being stuck in the lobby. Yeah, so I don't know what's wrong with that. Okay. In any case, so that's going to be the accounting equation. So I'm not sure you'll be tested on T accounts, but it's very important that you understand and know how they work. Okay. So let me grab this book again. So I'm going to go to the next page now. Okay. So the things I want to cover with you, well, the first thing I want to cover with you, there is depreciation in this. Let me actually open this book. There was nothing in here. So if you go to chapter 2, because as far as I can see, chapter 1 is mostly theory. Yeah, chapter 1 is mostly theory. Chapter 2, do I want to touch chapter 2? Okay, so chapter 2 is just your financial statements, how they normally are. I'm going to pass through that as well, because I'm going to teach you this stuff all together. Okay, so by chapter 3, you have the calculating of cost of sales. So I need to teach you how to calculate markup. So before we're going to build any of this, I'm going to move through the topics that I need to cover with you for you to know this stuff. Well, I suppose. Okay, so say you buy something. This is your transaction. You buy stock. So stock is anything that you're selling. So I could have said you bought microphones for resale purposes. It's stock, it's merchandise, it's trading inventory. You buy stock for 10,000 Rand, okay? From a store, okay? 10,000 Rand, I won't include VAT. Fine, and you use a markup of 50%. In fact, I'm gonna do this. You buy stock from a store. There are going to be 2 accounts here. So I'll do the selling after. So you drop your T accounts, right? You have your trading inventory. Okay, I'm gonna write it how I usually write it. TS just means trading stock. I'm so used to writing it like this, but it is trading inventory. So trading inventory is an asset, so it's going to increase on the debit side and decrease on the credit side, right? Then over here, you bought stock. I'm going to say you bought this stock with a check. So you bought it with actual money. So now you're going to use your bank account. If you had bought this stock on credit, then what you would use is creditor's control, right? So you have a plus here, you have a minus here because this is also an asset. Fine. So then you're going to learn about the contra accounts and the cross-reference rule in accounting. So, but what I want you to do before any of that, I need you to think about accounting logically, okay? You bought something using money in your bank account. So obviously the money in your bank account is going to decrease. So you're going to put it on the negative side, if you will, of your bank account because you need to decrease the amount of money in your bank account, right? And then the contra account is going to be your trading inventory. What I mean by a contra account, I mean, so you see this is the amount, this is going to be the account that shares the same amount. This is the partner here. So you bought money, but for what reason? You bought it for trading stock, right? You took out money in your bank account for trading stock. That is the contra account. Now your stock, your inventory. If you have no chairs in your workshop and now you just bought 10 chairs, you now have plus 10 chairs in your workshop. So your trading stock will increase, or your trading inventory rather, will increase, and then you'll have the amount of money over there. Okay? Now you sell it. Okay? Now you sell this. So maybe I can also do this. I can draw like a mini income statement. Sales, rev. No, I'll do this after. I can do it now. Statement of profit or loss and other comprehensive income. I have sales rev. I have cost of sales. My cost of sales, if you agree with me, is 10,000, right? Well, it's not my cost of sales yet. I'm going to make it my cost of sales now, but it's not my cost of sales yet, so I'll remove it. It's only cost of sales after I've sold it. And then on the next page, I'm going to draw a statement of financial position. Okay, so I'm not going to have non-current assets, so I'm just going to write current assets. Okay, and I have inventory. I just bought inventory of 10,000. Fine. Then I sell the stock. So I sell the stock to B store at a markup of 50% on cost price. Okay. So let me open a new Word document because I want to show you something on the side quickly. I don't want to scroll here. When you're dealing with markup, there's two methods of markup. I'm not going to show you the two methods of markup yet. I'm going to show you how to calculate this, and then I'll show you the two methods of markup. Okay. So when you have markup on cost price, why is it erasing my stuff? Markup. What the hell? Markup. Okay, that is weird. I'm just going to close this. And I'm just going to use the same document I've been using because that is creepy. Let's go down here. Okay. If you have your markup on cost price, you have the following. Well, every time you're dealing with markup, you can draw this table for yourself. It's very nice. So these are going to be the percentage representations of your amount. So you have your cost price, you have your markup, you have your selling price. Okay, this is how markup works. You have cost price that you're going to add a markup to, and you're going to get a selling price. Okay, so these two, when you add them, they must equal your selling price. Okay, now if your markup is based on cost price, where am I going so far? Your markup is based on cost price. So your cost price has to be 100%. Now, if you get 30 out of 60 for an exam or a paper, whatever, multiply by 100, obviously, not 1,000. This is 50%, right? This 50% is based on the 60, right? Meaning that if you had 60 out of 60, you would have gotten 100%, right? So now what I'm saying is the markup is based on cost price. So your cost price has to be 100% because if you have cost price over cost price, you have 100%. Okay, so that's how it works. So if your markup is based on selling price, your selling price will then be 100% in this equation. Fine. Your markup was 50%, right? Now, the 100 plus the 50 will give you 150. This is your selling price. I know I drew this line a little too low. This is your selling price, 150%, right? Fine. Now I want to erase this down here because I want to work with calculations and draw things. there's a few methods when it comes to markup. So they could either give you markup or they can give you figures for you to calculate markup for yourself. But if you were to calculate markup, the formula for markup, so markup, the formula for markup is equal to profit. And when I say profit, I mean gross profit, not net profit. So gross profit over cost price, okay? So cost price is cost of sales multiplied by 100. Okay, then you will calculate markup. But if you already have markup, you can then utilize this formula. Amount multiplied by what I want over what I have. And I always tell my students, this is a formula for life. You have the amount of money that you have the things that you you have the amount of money that you have, you have the things that you want, and you make the calculation to get to what you want. Fine. So if I go back up here, where is it now? Okay, 50% on cost price. Now I have 10,000 Rand, right? This is my amount. Let me rewrite this formula. Amount multiplied by what I want over what I have. Okay, so this is my amount here. My amount is 10,000. So what I mean by have is what does the amount represent, right? This amount is how much you bought the stock for. Remember I said your cost price is 100%, right? So if I scroll back down, your cost price is 100%, right? What are you looking for? You're looking for your selling price, which is 150. This is what you have. This is what you want. So obviously what you have and what you want will change based on what you want and what you have, right? So what you have is the 100. What you want is the 150. Click in there. Let me pull out an on-screen calculator. Come on screen calculator. Wrong side. You're gonna come this side. Okay. So the 10,000 multiplied. So 10,000 multiplied by 150 divided by 100, and you'll get the 15,000, right? So this is your selling price, 15,000. I want to open a page between these two pages because I shouldn't have. Oh, I forgot. I didn't include my mouse in this equation. Insert page break here. Please insert it. Thank God. Okay. So now I need to draw 40 accounts for selling price. You're gonna see just now. So I have T account number 1, number 2, number 3, number 4. I have sales. Sorry, I don't know where I went. Okay, I'm gonna say that I sold this cash. Sold stock to B store at markup whatever, and was issued a receipt or issued a receipt so that I can make this bank. If it was sold on credit, this would have been debtors control. So I have bank, which is an asset, so plus minus. I have sales, which is an income, so minus plus, owner's equity, income. Then I have cost of sales. You see, it's only becoming cost of sales now, which is an expense account. So minus, sorry, not minus plus for an expense account, plus minus expense account. Then I have trading inventory, which is an asset, plus minus. Okay, so first we deal with the top line. Okay, so the top line is as follows. we receive 15,000 into our bank account, right? So our bank account needs to increase. So on the debit side of my bank account, I have 15,000. My contra account is sales, right? Sales is increasing. I have made one more sale, an additional sale, right? So I have more income and my contra account is bank. That's my top line. My bottom line is my trading inventory. Remember now, we are selling these 10 chairs. You don't have them in your warehouse anymore. So you have removed them from your warehouse. You must show that they left. You must also remove them from your books. And remember, they came in there at a cost of 10,000. If you don't remember, I can scroll up for you. They came in at a cost of 10,000 there. So now I'm putting 10,000 on this side, and it's going to cost of sales. And then in cost of sales, I have 10,000 now being recognized for the first time because I made a sale. Now, when you're dealing with T accounts, if you have to deal with them, it's okay to come over here. You're actually supposed to do this. Come over here and write 10,000 cost of sales. So you show that there's nothing in this account. I just separated it so that I made it clear. Okay, fine. So let me remove this. Otherwise, okay, so now I made a sale. Okay, I'm gonna plug in my mouse. I think this pen has charged enough. Okay, so now I have made the sale, right? So I'm gonna go to my statement of profit and loss and other comprehensive income. I'm gonna recognize a cost of sales of 10,000, a sale of 15,000, and my gross profit is 5,000. That's my gross profit. I go to, no, I don't go to this. Oh, no. So that is your transactions. That's what you would do, right? So that's how you'd calculate your markup. Now I just want to show you something here. Obviously this inventory will go down. So the next year it'll be 0. There'll be no inventory. It'll be 0. One thing before I do move on. Your statement of profit and loss and other comprehensive income shows the movement. So this is the movement per year or per month or per 6 months, whatever. Your statement of financial position shows the balance. So it shows, that's what it used to be called the balance sheet. It shows the position. This is how much we have right now. So if I added, so now, like I said, now we are at 0, right? Next month or next year, whatever the case, we sold this thing in. If I added another 1, I would have 10,001. Whereas with this one, it will just show +1. Okay. He's making a random example there. Okay, this is what I wanted to do. So now here, I'm just going to show you something. Remember I said to you, was it on, which page was it on? It was on the page down there. Remember I said to you that you could calculate your markup if you're not given, and you could use this formula here, right? So I'm going to use this formula to calculate markup just to show you. So I said my formula for markup is gross profit over cost of sales multiplied by 100%. My gross profit is 5,000. Sorry, an additional 0 there. It's 5,000. My cost of sales is 10,000 multiplied by 100. So I have 5,000 divided by 10,000. And that is, multiplied by 100. And that is 50%. So that is the same 50% that I said my markup was. So that's how you'd calculate that. Now, to calculate markup, I'm moving directly to that. You have two markups here. You have markup or markup on cost price. If they say markup, they're talking about on cost price. Then you have gross margin or markup on selling price. I'll just write down there gross margin, and I'll just write there markup. Okay, so the formula for calculating markup is markup is equal to gross profit over cost price multiplied by 100. And then for gross margin, it's going to be gross profit. Sorry, my handwriting is becoming bad for some odd reason. Over selling price multiplied by 100. Selling price or sales. So if you have to do the same calculation, your gross profit was 5,000, your sales was sitting at 15,000 multiplied by 100, and that would be, let me see, why did my calculator like disappear now? Did I close it by accident? It's weird. I'll end up using my Casio next to me. Okay, so we have 5,000 divided by 15,000 multiplied by 100. Okay, I have 33.333 recurring, right? So 33.333 recurring. I built my table. Okay, I built my table. I have cost price, I have gross margin, I have selling price. Remember I said this will now be 100%, right? Remember now, cost price plus markup or gross margin will give you your selling price, right? So I have to subtract here. So I have 33.33. So here I will have 66.66, okay? So because of rounding, my answers will be a bit off, but I'm just going to show you something here. I have amount multiplied by what I want over what I have. My amount, original amount, was 10,000, and I was looking for selling price, right? So I had cost price. I had the 66.66. I wanted what is this thing? I wanted the selling price, which is the 100. Now, when you're using decimals like this, I need you to give me at least 5 if you want to have the same answer. Alternatively, you could just use a Casio, and it's easier with a Casio because you will go shift, well, you'll write the amount. Sorry, let me just start from scratch. That's not my eraser. So you'll write the amount, and then you'll say multiplied by, you'll press the fraction button, you'll be met with that. Then you'll press shift, and then you will press the fraction button again. After you do that, you will get a mixed fraction. After you get a mixed fraction, what you'll then do is you'll say 33/1/3. So your sum will look something like this. 10,000 multiplied by 100 over 66, and then this is going to be 2/3 if I'm not mistaken. 66.66 recurring. 66. I think it's 2/3. It should be 2/3. Yes, 2/3. Okay, so that way you'll then get your answer. Okay, but let me do it with this calculator here. So 10,000 multiplied by 100 divided by 66.66666, and I get 15,000. So the 15,000, and then obviously I can't round up any further, and it's the same thing. So usually retailers, I almost closed it this time, retailers will use the gross margin, and usually manufacturers will use markup. But whichever one you get in your question, because anybody can use whatever they want, that's how you do it. And I'm just undoing here. I thought it would be faster. Okay, where's my eraser? Can't do this anymore. So those are the two. Fine. So then when you build your tables, like I said, with markup, you have cost price 100%. Markup, selling price, right? And then you have gross margin, cost price, gross margin, selling price. Selling price, 100%, right? And then at the end, you have that beautiful formula. Now remove the whole thing. You have that beautiful formula at the bottom, amount multiplied by what you want over what you have. Okay, so that's markup. Fine. Now I'm going to move on to depreciation, I think. So with your ratios, I mean, the ratios are self-explanatory. They have them there. You just like the net profit percentage is your net profit over your sales. Your gross margin is just your, I gave it to you already, your gross margin, your gross profit over selling price. Percentage change, so let's say in 2015 and 2016, I had selling price or sales of 26, and then now I have 30. What you're gonna do is you're gonna say new minus old over old multiplied by 100%. So you're gonna have 30,000 minus 26,000 in brackets divided by the old, which is the 26,000 multiplied by 100%. So if I do this on my calculator, so 30 minus 26 is 4. So 4,000 divided by 26,000 multiplied by 100 is 15.84. 84, right? Nope. 34, 38. 38%. So that's percentage change. Okay, fine. And I'm noticing that time is like leaving us. It's fine. I will catch us up, if not today, on Thursday, but I will catch us up. But I will finish everything. Okay, then there was discounts, then there's depreciation. Okay, so before I get to depreciation and discounts, you have accruals, which is just your matching principle. So what that means is if I pay for rent, so if you're preparing the books for 2015, and let's say let's make it simple. Let's say our financial year runs from the 1st of January to the 31st of December. If in December our client pays us rent for January and February as well, we will not recognize that this year, we'll recognize it next year. I did look through your book thus far. You guys don't necessarily do prepaid expenses or income received in advance. As I've seen thus far, I'm only up to chapter 6. But you would recognize that as an income received in advance if you're the one receiving the rent, and you'd recognize that as a prepaid expenses if you're the one who paid the rent ahead of time, and then next month you will then recognize it as the rent for that month, so forth and so forth. And I see it doesn't go, okay, so you guys don't go deep into depreciation when it comes to formulas, but I'm just going to show you 2 formulas for depreciation here. And then I'm going to do the financial statements. Okay. So you have 2 methods of depreciation. You have the cost price method. So it's the cost price or straight line method. Okay, first things first, before I get to depreciation, over here, page break. if they say to you, your cost price is 500,000, okay, and your useful life, so the useful life of the thing is 5 years. What they mean by useful life is that you can only use it, it's only going to be worth value for 5 years. After 5 years, it'll be worthless and you'll dispose of it. And then let's say they say your residual value is 20,000. So they're saying now, after 5 years, it'll be worth 20,000. You can simply calculate this by saying, so this is the cost price minus residual. So obviously you will not include residual in this calculation. You'll put it aside, divided by useful life. Yeah, divided by useful life. So this is how you'll calculate depreciation. So you'll say 500,000 minus 20,000 in brackets over 5 years which will be 480 divided by, so it's going to be 480 divided by 5, which is 96,000. So every year this whatever this asset is will lose 96,000 in value. So you'll subtract 96,000. So you'll have your cost, which is 500,000, and then your accumulated depreciation will be 96, and then your carry value will be the difference. So that will be for year 1. I'm just going to minus 500,000 here. So year 1 we have 404. That's how much it's still worth. Year 2 we subtract another 96, so forth, so forth. Okay, that's depreciation, right? So you know depreciation is your assets losing value over time. Okay, now the two methods. The cost price method, I'm going to write the same thing. So I have 500,000 again. I'm not going to include useful lives this time. We're going to depreciate this at 25%. Okay, this is what you're going to do. You're going to say year 1's depreciation, 500,000 multiplied by 25%. That's going to give you, let me see, 500,000 multiplied by 0.25. That's going to give you 125,000 each year. What do I mean by that? This is your depreciation for year 1. Year 2, your carrying value is now the 500 minus the, what is this? Minus this, so minus 500, 375. So now we have 375 minus 125. Okay, now I'm calculating carrying value. Sorry, no idea why. Okay, but each year you're gonna have the same calculation. It's gonna be 500,000 multiplied by 25%, 125. I almost did something else here. So forth and so forth. Year 3, same thing, 125. Year 4, same thing, 125. And then it's going to be worth 0, okay? Because those are the 4 25%. Okay, fine. Then you have your reducing balance method. Sorry. Reducing balance. Okay, sorry again. I'm realizing. Reducing or diminishing balance method. Okay, so the straight line method or the cost price method, that's your depreciation calculated on cost price, right? It's calculated on cost. With reducing balance is calculated at carry value. Okay, so year 1, same, right? We have 500,000. Yeah, I didn't write that so nicely. Multiply by 25%, that gave us 125,000 Rand as depreciation. Year 2, however, we have 500,000 minus 125 to get our carry value multiplied by 25%. So this is going to be different about these two depreciations. So now we have 500,000 minus 125 multiplied by 25%, 93, 750, 93, 750. This is a carry value that we did in our previous thing. Actually, now that I'm thinking about it, so 500,000 minus 125 and an additional 125. So obviously you can just write the carry value answer here. If you do want method marks, if you write it like this, if you still get it wrong, then we'll see where you got some of the stuff. And I see my calculator has deserted me another time. So I'm just quickly gonna use my my handheld calculator here. Oh, okay, here it's back. It's taking too long. 500,000 minus 125. Okay, there we go. 500,000 minus 125 minus another 125. I get 250 multiplied by 25. 62, 500, and then finally, yeah, 4. I have 500 minus 1, 2, sorry, 3. Undo that last thing. 1, 2, and 3. Multiplied by 25. Okay. So I have no idea why I'm doing this. Sorry guys. 125. Okay. This is where I made the mistake. 125 over here. Let me move this. Okay. And this. And that. Okay. So 125, the first depreciation. I'm not focusing here. The second depreciation, 93.75. Okay. Okay, then I don't need to have that there. And then the second year will be the 93.75 and another one. 500,000 minus 125 for the first year's depreciation minus 93.75 for the second year's depreciation multiplied by 25. 73, I'm going to round it off to the nearest rand value, so that's 7313. 7313, so that's 7313 over there. So 500,000 minus the 125 minus the 93,750 minus the 7313, and I get a okay, wait, hold up, multiplied by 0.25. 52.7, I'm gonna round it up, so I'm gonna drop those last. 52.734, so 52.734. Okay, so you'll see that the depreciations are quite different, right? So you have more depreciation than you have over here. So those are the two methods of depreciation. So fine. Amortization is the same. Amortization is, so depreciation is you depreciating a tangible asset, and amortization is you depreciating an intangible asset. Okay, fine. So now the statements, because I think those are the last of the mini things before we get to the statements. Yes, the statements. So what's important about the statements is you know the format. Okay, you need to know the format of the statements, and the format of the statements in your book are quite different from, a little bit different from what I'm used to. But I'll try to use your format because you're the ones who are going to be studying this, not me. We'll start with the statement of profit and loss and other comprehensive income. Okay, so what I do notice is that they give you the amounts. They don't necessarily ask you to calculate a lot of stuff right now. So that's what I'm going to do right now. So statement of financial position. I have non-current assets. Or what we call PPE, plant property equipment. That's going to be the asset over there. Maybe I'll just put them a little bit to the left here to show the heading and the non-heading. I have current assets. This is inventory. This is trade receivables. I'm wasting time. I'm going to type this. Yeah, I'm just going to type this. And that is far. Okay. So statement financial position, but with hard classes, I'm going to have these pre-typed. Financial piece. Okay. We have it's current assets, tree. I had them. Equivalents, but you guys don't actually have cash equivalents. You just write cash, so I'm gonna leave it as cash. Fine, and then total assets. Just check. That's true. Okay, when I open a separate line here, I'm gonna write PPE. I'm gonna have to do the note. You guys don't do the note. Okay, so I'll write the cost. I'll write the what's this thing? The accumulated depreciation. Then owner's equity, you would have capital introduced, add back profit, as drawings. So usually these are split up. So so if you look under your non-current, if you look here under non-current assets, this is usually just called PPE because you do a whole separate note and we calculate the cost. We calculate the value of your non-current assets. And then over here under your equity, we just get the amount, and then you have a separate statement called changes in equity. I'm not sure if you guys do it at a later stage. Like I said, I've only gotten thus far in your textbook. Fine, and then we have long-term liabilities. Loan or your mortgage loan, and then you have wait. When it says long-term liabilities, I have no idea why they don't just say non-current liabilities, and I don't know how they would mark it based on that. So I'll just leave it as long. Your current liabilities, which will be your trade payables, your bank overdraft, your short-term loan, year bills. Then you'll have your total equity liabilities. Okay. So if you go to, let me see, which one do I want to use? If you go to, in your textbooks, just trying to find the page here. Was this from this is from another thing. Where's that other one about building both of them at the same time? I think it is this one. Okay, go to page 78 of your books. So go to page 78 of your books. I'm going to use this one. So on page 78, well, it starts on page 49, but it's fine. We're gonna start on page 78. So from there, where they tell you where exactly everything is going to go, you will see the following. So they have there, let me see, the beginning there, they have the revenues, right? So if you look at your trial balance, what you're looking at there is your trial balance. So you have your revenues, all that stuff. I'm going to start with the statement of financial position because that's what I drew up here. Okay, so in your statement of financial position, so if you look at the stuff that says statement of financial position, you'll see cash in the bank, you'll see drawings, you will see trade receivables, you will see non-current assets, you will see trade payables, you'll see capital, and then you'll see your inventory. Okay, I'll start with the non-current assets. So where is it? Non-current assets was 18,000, and you'll see it's written there 18,000. So what you would do, if you had a calculation here, you would write a sum minus another sum, and then under non-current assets, you'll write the figure, right? So we don't have to fortunately do that. So we can immediately go there and write 18,000 like they have over there, right? Now, so I can remove this for now, for this one. Then you have, maybe I can make these bold. Make that bold. Thank God. That's so much better. Okay. Then the next one there, so I'm just gonna go down my statement here. I'm gonna look for inventory. So let me see. I have inventory on the 1st of June for two okay, let's say I have inventory for the 1st of June, so I'm gonna put there, I'm gonna say equals my inventory at the beginning of what is this, of this year. It's sitting at 34,000. It is it this year, right? Yeah, 34,401 rand, right? I see I have purchases of 281, and let me see. It does say my closing inventory is 35,000 down there. So, okay, I'm lying to you. My inventory, okay. That's the difference. So I'll draw my statement of profit and loss as well on the side here, so that I can somehow just do that one as well. Give me a second. Okay. Like sales rev, revenue. No, I'm gonna put it on the same side actually, on the same sheet. Statement. Or loss and other comprehensive income. Okay. Now the sales rev here. Cost of sales. Okay, and then I'm gonna put gross profit. I'm gonna do it a bit differently. Otherwise, I'm gonna fumble on my words. I'm gonna do it in the way I'm used to, gross profit. Okay. I wanna add other incomes and all that stuff, but I'm gonna add them as I go. Okay. Fine. So my purchases, you'll see there, I have opening inventory of 34,000. I don't know what cost of sales here. Of sales. Okay. Under my cost of sales, you'll see I have my what you call, where is it now? Okay. So my opening inventory was 34,401, right? Then I had purchases of 281, so 281 83. You'll see them middle there, just under traveling expenses, 281, and there is no plus over here. 8134 or whatever. Cool. Did I have any returns? It doesn't seem like I had any returns. Okay. Then my closing inventory was given to me at 35,433. Okay. So this is my value of my cost of sales. Now my inventory will be the value of my closing inventory. So 35,433. If they say you walked around, you basically did a stock count and you found that this amount is actually 30,000, it means that the 5,000, it means that this 5,433 Rand is missing stock. It'll be added here as part of cost of sales. Okay, fine. Then one other thing, let me see. Okay, so now my trade receivables. Trade receivables is sitting at 38,384. Do I have cash in the bank? I do. I have cash of 1,700. And then do I have an allowance, by the way, for my trade receivables? I see it says allowance. Let me just find it. It is probably in the sentences that I missed. Okay, if you read up here, so there by your trial balance, if you just go up a bit, the second paragraph, the last paragraph that starts with next, we look at just above it says the 3.9 potential loss in the business. Okay, it's written somewhere. Okay, go to number 2 at the beginning of this question. It says Hilda sells goods at a total price of 3,900 Rand on her normal terms, which are payment within 30 days of the invoice. I see nothing about allowances here. Okay, Hilda is beginning to have doubts about these assurances and intends on threatening whatever legal action, blah, blah, blah. It's not saying allowance. It's not saying allowance. To change laws, okay. Well, I want to see where it says she raised an allowance for this thing. Okay, in that long ass paragraph, it does say doubtful. It says doubtful trade receivables. So usually, what an allowance is, we borrow, we put money aside. Let's say the 3.9. We put money aside in case somebody doesn't pay us back. So,
Hi, sir. Sorry. Hello.
yes, sir.
Sorry.
Scared
You
me.
can see
Yes,
on
sir.
page 78 this in the first paragraph this but a deduction from the total in the form of an allowance. What does that mean? Are you referring to that?
Where is it? Yes, that's what I'm referring to. Where is it?
On the top page 78, the second paragraph, the 1,200 euros.
Oh yeah, that I saw. I was just looking for it. That's their calculation. Obviously, they'll take it from the sentence in the
Oh, okay.
paragraph. They won't just
Sorry.
find it. They won't just pull it out of anywhere. But yeah,
Okay.
thank you so much, sir. So what was I saying? Okay, so we basically put money aside. So we'll put money aside for if somebody doesn't pay us back, we'll put money aside as credit losses, allowance for credit losses. We'll put money aside if we're not sure if we expect to give somebody a discount, like a 5% discount, we'll put money aside, allowance for settlement discount granted. The reason we do this is because we are trying to protect the cash flow of the business. So we want to make sure that when we do give out these discounts or people don't pay us back, we can just pull this money from where we had stored it for these what is this, for these kind of circumstances, whatever you want to call it, but is to make sure that the business is like running as smoothly as possible. So when you increase this allowance, so I'm gonna do this. So this is your bank account right here. Yeah, your bank account, and then this is the allowance. If I increase this allowance by 50 rand, so I put plus 50 rand to this allowance. Let's say this allowance was sitting at 100 rand. Now it's sitting at 150, right? I put 50 rand to this allowance. In my statement of profit and loss, I am going to subtract the 150 there. So I'm going to have 150 there. I'm going to have 150 there, right? In my statement of profit and loss and other comprehensive income, I'm going to show the movement. Now, it went up by 150, meaning that I had to reduce my bank account by 50 rand, meaning that my allowance, okay, let's bet it. Allowance for, let's say, it's credit losses, adjustment will then be 50 rand, and this is a negative under my expenses, whereas under my financial position, I'm just going to take the full 150. So that's the difference. As I said, one is the movement, which being this one, and the other is going to be the position being this one. Okay, so I'm going to remove all of this now. Okay, I'm just going to erase it actually. Okay, fine. Let me go back to that page. So my receivables, I'm going to remove that allowance as well. Why isn't my thing working now? That's weird. I can't even see my formulas now. Okay, receivables. My receivables, if I'm remembering correctly, seeing it doesn't want me to like put stuff in there. 38,384. Is that allowance that they put in there? Okay. But before the allowance, I see there's also something else there. 1.2 due from Jimbo excluded together, blah blah blah. Recovered in June, but is deducted from the What is this 1.2 now? 1.2 is owed by Jimbo Associates. Jimbo, head of businesses, disappeared to South Africa, taking with him all the cash that was left in his business, leaving many angry creditors behind. It emerges that his creditors include unlikely to ever receive payment. Okay, so the 1.2 is the bad debt. So if somebody doesn't pay you back, and to find them, it's going to cost us more than it is to just write them off. We just write them off. That's what happened here. We just wrote them off, and then the 3985 is the allowance. So I'm just gonna show you how it would look in a note. I'm gonna show you how it would look in a note just now. Okay, so if we had a note, we would have trade. Why can't I do anything? Okay, here we go. Trade receivables. I would have debtors control, which is sitting at, where is it? Where is debtors control now? 38384. I would subtract from my trade debtors my credit losses that I would do in the brackets. So I'm just going to remove this. Debtors control out of the 38384 minus the 1.2 of credit losses, and I would have the sum, and then I'd have my allowance for, it said doubtful. Okay, it's doubtful receivables, and that was sitting at 3985. So the one that you see at the top of the page would look like that. The balance would go straight to receivables. That's if you had to create notes, but I see you guys don't create notes in here. Okay, fine. Then, so fine, done with that. Cash in the bank was 1.7, like I said. So if I look over here, we are fine on this one, we are fine on this one, and this one. Okay. So our current assets is going to be the sum of these three. So I'm going to go sum of these three. I have 70,000 and whatever over there. And then I'm going to have the sum of these two. So I don't even need to like, just the 88. So now this is immediately going to be our total liabilities and equity and liabilities, right? So then let me see. Payables, what do I have? Payables have 34,000, and it seems like there's nothing else to write home about. So 34,600, and then we would put it here. So that's usually how the format would go. Um, I think I'll try to stick to your format in the book actually. 600. Fine. Do we have a loan? Okay, I have drawings over there. Receivables, done, done. Payables, done. Have you a loan yet? I don't know if there's a loan. No, no loan. Okay. Then your capital portion. Fine. So they gave you capital. Your opening capital, let me see, the 1st of June, it was 49,000. So I'm going to go 49,855, right? Then obviously your net profit you would have gotten from your what is this thing, your statement of profit and loss. So that's going to be open now. So I'm going to go back here. This cost of sales I have over here. My sales, if I go back to sales, revenue is 3989. As far as it is, let me see. Yeah, so there are no returns here. So your sales is as is stated there in your trial balance. I'm gonna put this as a negative, or I can just subtract this one minus this one. So this is your gross profit over here, right? As you see over there. That's how you'd calculate your gross profit. I just want to see if there's anything. No, there's nothing hectic. Okay, so that's your gross profit. I've already calculated your cost of sales, which is the most difficult thing to do. So I want you to look in your book now. I'm not going to do the expenses. If you look at your book, you'll see the list of your expenses there. Look at the bottom. You see that allowance for doubtful debts there. You see it's 3985, and it's also 3985 in your financial position. Okay, I'm not showing my stuff. If you look over here, it's also 3985. So it's the same, but I said that what there would be there, one would be position, one would be the movement, right? So how can they be the same? And the only reason they're the same, okay, I'm just gonna do this that I just did. The only reason they're the same is because we didn't have an allowance for doubtful debts to begin with. So we move from zero. So both the position and the movement is the same. So that's the only reason there. If we did have a different number, if we already had an allowance, it would be a different number. But I want you to pay attention to the profit. So the profit at the end, the net profit after subtracting expenses of 65,000 is 42,618, which is what you need for your capital. So your profit, where's this? Capital is 49 over here. Did I write it according to this format so I can just use it? Yes, okay. So my profit is sitting at 42,618. And do I have drawings? Yes, I do. My drawings are 38,380. Okay. So obviously that plus this minus this will give me my actual capital. Fine. So instead of doing it like this, I would do it like this, but this is me being me. I'm going to add my profit of 42,618. I'm going to subtract my drawings of 380, and I'm going to get the 5409. Okay. I'm going to remove this, and I'm going to remove this. So moving forward from when you go on, I'm going to start using your actual formats and not just changing them up. But the point I want to make here, where is it now? Should I see something here? This one plus okay, so there's no long-term liabilities. Okay. If you had long-term liabilities, I'm just going to change the number here. If this amount was maybe less than one, subtract everything that I wanted to. Amount was okay, I removed everything. Less this. If this is your amount here. Okay, no, maybe not less than one. Actually. Okay. I'm gonna subtract another 1,000. And this 1,000 would be the balancing figure for loan. What I'm saying is you would then say this amount minus this amount minus that amount would give you 1,000 rand that would be missing. You'd put it in loan. Usually you would do it like that. That's how you would build your financial position and stuff like that. Okay. I'm going to end the session here today. And then I'm going to continue tomorrow with your cash flow statement. And I'm going to actually set out these stuff. And I'm going to have a question to prepare every. Moving forward, I'm just going to have a question to prepare. I'm going to explain everything. Then we're going to do the question. And we're going to do it in that format. Because this one is kind of everywhere. Okay, but thank you so much for attending. Also, I did say, I don't know if you saw my announcement, go to the discussion and put down things that you want to, the topics that you want to cover in each section. So tomorrow's session is going to be on the next 3 chapters. So whatever you want to cover in there, whatever thing is stressing you, whatever question is stressing you, you can just type it in there and tell me, and then I'll cover it. But thank you so much for attending. The session ends here today. If you do have questions, you can raise your hand now. Otherwise, I will see you in the session tomorrow at the same time. Okay, no questions. Okay. Thank you so much, guys. I'll see you tomorrow.